What if I told you the stock everyone's panicking about today is actually setting up for the most explosive move of 2026? Hey, it's Smart Stock Sam here. And if you're wondering why NIO dipped today while simultaneously showing signs of a massive breakout ahead, you're in the right place. Because what I'm about to show you isn't just another stock analysis. This is the story of how a company went from death's door to potentially doubling your money, and why today's dip might be your last chance to get in before the big money takes over. For nearly 11 years, betting against NIO was the easiest trade on Wall Street. The bear thesis was bulletproof. They burn cash faster than they make cars. But something fundamental just shifted in February 2026, and most retail investors are completely blind to it. The question isn't whether NIO can survive anymore, it's whether you'll catch this inflection before it's too late. Here's what just happened. NIO didn't just improve their numbers, they obliterated their old business model. 1 year ago, Q4 2024, they were hemorrhaging $800 million in operating losses. Flash forward to today, they're projecting up to $173 million in operating profit. That's nearly $1 billion swing in 12 months. Revenue hit $5.1 billion, deliveries exploded 149% year over year, and suddenly the company that was supposed to go bankrupt is generating actual profits. But here's what Wall Street isn't telling you. This isn't about selling more cars. The secret is operational leverage, and it's finally kicking in. For years, NIO built this massive infrastructure, factories, battery stations, service centers, and it was bleeding them dry. But now, they're sweating those assets. Every quarter, they're squeezing out 4% to 6% efficiency gains. Their flagship ES8, it's printing money at a 20% gross margin with an average selling price over $57,600. That's $11,560 in gross profit per vehicle. This is what happens when a growth company hits critical mass. But the car business? That's just the appetizer. Here's the game changer nobody's talking about. NIO is pulling an Amazon. Remember when AWS seemed like a weird side project and then it became Amazon's profit engine? NIO just did that with batteries. On February 6th, they hit 100 million battery swaps. Think about that. 100 million transactions on infrastructure they own. Shanghai data proves these stations break even at just 60 swaps per day. And with over 3,700 stations deployed, they're not just swapping batteries anymore. They're running energy arbitrage, buying electricity dirt cheap at night, storing it in thousands of batteries, and selling it back to the grid during peak hours. NIO isn't just an automaker. They've become a distributed utility company hiding inside a car brand. What if their battery network becomes more valuable than the cars themselves? But a utility needs users, and that's where 2026 gets really interesting. NIO is flooding the market with products that cover every price point. The Firefly brand is targeting Gen Z with sub-$20,000 EVs. The Onvo L80 is ramping up for mass market volume in Q2, and on April 10th, they're dropping the ultra-premium ES9 flagship. But here's the lock-in strategy. They're building a hardware ecosystem. The NIO phone uses UWB technology that talks to your car. Walk up to your trunk and it just opens. Once you're in that ecosystem, switching to a Tesla or BYD means losing all that integration. It's the Apple playbook, and it's a moat that's incredibly hard to attack. Now, China's a massive market, but NIO's playing a completely different game globally. While everyone else is freaking out about US tariffs, NIO's setting up shop in Canada. They found a loophole, specific quotas that dropped their tariff rate to just 6.1%. They're building an export hub right on the North American border. When those tariff walls eventually come down, or when regulations shift, guess who's already established? This is surgical geopolitical strategy while their competitors are stuck fighting yesterday's war. So that's the fundamental story. But what does the chart actually say? We're looking at a textbook consolidation breakout pattern. The stock's been testing resistance at 491, and institutional volume just surged 148% above average. Translation: the smart money is already loading the boat. If we crack through that resistance, the 200-day moving average sits at $5.28. That's your first real target, and breaking that level changes the entire technical structure. But here's where it gets wild. The options market is setting up for a potential gamma squeeze. The put-call ratio is sitting at a very bullish 0.7, meaning way more people are betting on upside than downside. There are massive call walls at $5 and $5.50. Short interest is around 8% of the float. But here's the kicker. Shorts are covering, not building. If the stock rips through $5, those call options go in the money. Market makers have to buy shares to hedge, and that forces the price even higher. It could cascade. What if the same traders who got squeezed on Tesla in 2020 are sitting on the wrong side of NIO right now? Now, let's be honest about the risks, because this isn't a guaranteed moonshot. NIO just issued an OTA recall affecting 246,000 vehicles due to screen malfunctions. That's a lot of units. China also just implemented a 5% purchase tax on EVs, which could soften demand in the short term. And the big test is coming. Spring Festival travel is about to stress test their entire highway charging network. If those stations can't handle the surge, the whole utility narrative falls apart. Execution has to be flawless, or this inflection thesis breaks. So what's this actually worth? Wall Street's finally paying attention. JP Morgan's conservative at $7.0, but Nomura and Morgan Stanley are seeing $8.40 to $9 targets. From current levels, we're talking about a potential double if this profit trajectory holds. The re-rating is happening in real time, and the analysts who spent years calling this a zero are quietly upgrading. Before we wrap, a fair reminder like always, I am not a financial advisor, and nothing in this video is financial advice. This is purely educational content for informational purposes. You should always do your own research and consult with a licensed professional before making any investment decisions. Past performance does not guarantee future results, and all investing carries risk, including the potential loss of principal. Here's the bottom line. NIO is no longer just an EV company. They're an energy infrastructure play disguised as a car company. They've hit profitability, proven the unit economics of their battery network, and they're about to flood 3 different market segments with new products. The technicals are coiling, the institutions are accumulating, and the shorts are starting to panic. The old story was survival. The new story is domination. Today's dip? That might be the last time you see these levels before the breakout. The only question left is, will you be positioned when it happens? If this analysis helped you see NIO differently, smash that like button and subscribe to Smart Stock Sam for more deep dives the market doesn't want you to see. Drop a comment below. Are you buying this dip or waiting for more confirmation? Let's talk. I'll see you in the next one.